Is the nuclear revolution now? This video delves into the complex landscape of energy investment opportunities. We will analyze where capital is flowing and where future potential lies. Our primary focus is on comparing nuclear energy with more conventional sources like oil, gas, and coal, as well as the rapidly expanding solar sector. Understanding the dynamics between these sources is crucial for strategic investment decisions. The global energy landscape is undergoing a profound transformation. Driven by climate concerns and technological advancements, the traditional energy mix is shifting. There is a clear and accelerating shift away from fossil fuels towards lower carbon alternatives. This transition presents both challenges and significant opportunities for investors. The central question for investors today is, where should capital be deployed to capture the most promising returns in this evolving energy market? Identifying the sectors poised for growth is key. Please note, this analysis is for informational purposes only. It does not constitute financial or investment advice. Always conduct your own due diligence before making investment decisions. Our goal is to provide a comprehensive analysis of the current energy investment environment. We aim to reveal which sectors appear most promising based on market trends and expert projections. Nuclear energy is experiencing a notable resurgence in interest. Its unique attributes make it a compelling option in the pursuit of a sustainable energy future. One of the most significant benefits of nuclear power is its status as a zero-emission power source during operation. It produces electricity without releasing greenhouse gases into the atmosphere. Furthermore, nuclear plants provide reliable baseload power supply. Unlike intermittent renewables, they can operate continuously, providing stable electricity regardless of weather conditions or time of day. The development of small modular reactors, or SMRs, enhances nuclear energy's appeal through increased scalability and flexibility. SMRs are smaller, potentially cheaper, and quicker to build than traditional large-scale reactors. Insights from firms like McKinsey highlight nuclear's role as a crucial complement to intermittent renewables. It can provide the necessary stability to grids increasingly reliant on solar and wind power. However, McKinsey also points out that achieving significant nuclear expansion requires substantial financial commitment. The capital intensity of nuclear projects remains a key consideration. Morgan Stanley projects a massive investment potential in nuclear energy, estimating up to $1.5 trillion by 2050. This forecast underscores the significant market opportunity perceived by financial institutions. Key drivers for this projected nuclear investment include global net zero emission goals. Countries are looking for reliable, low-carbon sources to meet their climate commitments. Another significant driver is the surging demand from data centers. These energy-intensive facilities require constant, reliable power, which nuclear energy can provide effectively. Despite the push towards decarbonization, oil and gas maintain significant importance in the global energy mix. They continue to power vast sectors of the economy. McKinsey projects that global oil demand may peak around 2030. While a peak is anticipated, demand is expected to remain substantial for decades thereafter. Gas demand, in contrast to oil, is projected by McKinsey to continue growing in some scenarios. This growth is linked to its role in the energy transition. A primary reason for continued gas growth is its ability to balance intermittent renewables. Gas-fired power plants can quickly ramp up or down to compensate for fluctuations in solar and wind output. Major financial players like BlackRock maintain a stance of continued investment in oil and gas. They recognize the ongoing need for these energy sources during the transition period. BlackRock's portfolio includes large global energy investments, exceeding $320 billion. This demonstrates the scale of capital still allocated to the traditional energy sector. Coal's role in the global energy mix is undergoing a gradual decline. Environmental regulations and competition from other sources are driving this trend. McKinsey expects a gradual phase out of coal power generation in many regions. This transition is a key component of global decarbonization efforts. McKinsey projects that approximately 65% of coal asset revenues will need alternative mechanisms or replacement by 2040. This highlights the significant financial restructuring required in the coal sector. However, coal's persistence remains notable, particularly its significant role in developing markets. Countries like China and India still rely heavily on coal for their energy needs. Solar energy is experiencing rapid growth and is a leading force in the renewable energy transition. Technological advancements and falling costs are accelerating its deployment. McKinsey projects that renewables, led by solar and wind, could provide 45 to 50% of global power by 2030. This indicates a dramatic shift in the energy generation landscape. Looking further ahead, McKinsey forecasts that renewables could supply 65 to 85% of global power by 2050. This underscores the long-term dominance expected from these sources. Despite its rapid growth, solar energy faces challenges, including supply chain issues. Geopolitical factors and manufacturing bottlenecks can impact the availability and cost of solar components. Land availability is another challenge for large-scale solar deployment. Utility-scale solar farms require significant land area, which can lead to siting and environmental concerns. Intermittency remains a key challenge for solar power. Electricity generation stops when the sun isn't shining, requiring backup sources like gas or nuclear to ensure grid stability. Overall energy investments are projected to grow substantially in the coming years. McKinsey forecasts total energy investments could increase to $3.2 trillion annually by 2040. A significant portion of this investment is expected to be allocated towards renewables and decarbonization technologies. McKinsey suggests 40 to 50% of total energy investment will target these areas. Investment firms are actively participating in this shift. Blackstone, for example, has made significant investments in renewable projects, such as Invenergy. BlackRock exemplifies a balanced investment approach. Their portfolio includes substantial investments in both traditional fossil fuels and rapidly growing renewable energy sectors. Investing in the energy sector involves navigating various risks and challenges. Each energy source presents its own set of potential hurdles. For nuclear energy, high upfront costs are a significant risk. Building new nuclear power plants requires massive initial capital expenditure. Long construction times also pose a risk for nuclear projects. Delays can lead to cost overruns and push back the timeline for generating returns. Morgan Stanley highlights potential labor shortages as a risk for nuclear expansion. A skilled workforce is needed for construction, operation, and maintenance of nuclear facilities. Conventional energy sources face risks from increasing regulatory pressure for decarbonization. Policies aimed at reducing emissions can impact the profitability and viability of fossil fuel projects. Declining coal demand, as projected by McKinsey, represents a specific risk for investments in the coal sector. Assets may become stranded or require significant write-downs. Solar energy, while promising, faces risks related to its inherent intermittency. Managing grid stability with high levels of solar penetration requires significant investment in storage or backup capacity. Supply chain bottlenecks, as noted by McKinsey, also pose risks for solar projects. Disruptions can delay installations and increase costs. In summary, nuclear energy presents strong long-term potential, with projections reaching $1.5 trillion in investment by 2050. Its zero-emission baseload power is highly valuable. However, nuclear faces significant challenges, including high costs and potential construction delays. These factors can impact project timelines and financial returns. Oil and gas are expected to remain resilient in the near term. While oil demand may peak around 2030, both fuels will continue to play crucial roles in the global energy mix for years to come. Solar energy leads the growth in renewables but requires backup solutions due to its intermittency. Its rapid deployment is transforming the power sector. Coal is gradually fading from the energy mix in many regions. However, it persists as a significant energy source in certain developing markets. So, is nuclear energy the next big wave of investment? Based on projections and its unique attributes, nuclear certainly has the potential to be a major wave, particularly in the long term. However, near-term stability and continued investment opportunities may lie more with conventional sources like oil and gas, alongside the rapid expansion of solar. These sectors benefit from existing infrastructure and established demand. A key takeaway from this analysis is that no single energy source is likely to dominate the future landscape entirely. The energy transition is complex and multifaceted. Therefore, diversification is crucial for investors in the energy sector. A balanced portfolio across different energy sources and technologies may offer the most robust strategy. We hope this analysis has provided valuable insights into the evolving energy investment landscape. We are interested in your perspective. Please share your opinions and insights in the comments section below. What do you think about the future of nuclear energy investment? If you found this analysis informative, please consider liking the video. Your support helps us create more content like this. Don't forget to subscribe to the channel to stay updated on our latest analyses of market trends and investment opportunities. And hit the notification bell so you don't miss our future videos. Thank you for watching.